Some farm families gift ag commodities to their children as part of their tax planning strategy. The technique can save income as well as self-employment tax. Joining us now for today's Rural Money segment is Roger McEowen with the Washburn University School of Law. Roger, thanks for joining us once again. So how should commodity gift transactions actually be structured?
Well, good morning, Janet. It's a pleasure to be with you. I think the key thing here when we talk about gifts to children, and now we're not talking about gifts to a charity, but to kids and other family members, is that the commodities have to have been raised or produced in a prior tax year. That's the key, because if that doesn't happen, the IRS is going to take the position that a farmer is not 100% in the business of raising those crops for profit, and they're going to require that a pro rata share of the expenses of raising the commodity will not be deductible on the farmer's tax return. So you got to do it from a prior year's crop.
So what happens if the gifted commodities were not raised or produced in that prior tax year?
Well, if you're going to gift it from the current year's crop, then the donor's opening inventory has to be reduced for any costs or undeducted expenses relating to the transferred property. So that means that the donor, the parents here, are not going to be able to deduct their current year costs that apply to that commodity. So that's the problem.
And what about the tax consequences to the donee?
Well, the tax consequences to the donee, of course, they get a carryover basis in those crops from the donor, from the parents. So when we're talking raised commodities given in the year after harvest by a cash method farmer, the donee is going to get the donor's basis, which is going to be zero. All the costs of raising that crop has already been deducted. Now, if they're on the accrual basis, then an accrual method farmer will have an income tax basis in raised commodities. But most farmers are not on the accrual basis. They're on the cash method.
And what about the impact of the Tax Cuts and Jobs Act on commodity gifts to kids?
Well, that's a big implication there, because under pre-TCJA law, the child who got a commodity gift and then sold the commodity usually paid income tax based on the parent's tax rate. Now, there was a smaller amount taxed at lower rates on unearned income. Earned income, such as wages, is always taxed at the child's tax rates. But under the TCJA, for tax years starting after 2017, the child's tax rates on unearned income are the same tax rates and brackets that apply to estates and trusts. So what that means is once the child's unearned income reaches $12,500, then the applicable tax rate jumps to 37% on all the unearned income of the child above that amount. I think that's going to make it much more costlier for farm families to gift grain to their kids or grandkids and receive any tax savings.
Roger, just out of curiosity, is there any kind of an age limit on when this can all take place? I mean, are we talking young children or children that are maybe of working age on the farm?
Well, there's no age limit, but there is an additional tax that kicks in. It's called the kiddie tax, and that applies to a child that hasn't reached age 18 before the close of the year. And it can also apply to a child who has not reached age 19 as of the close of the year, or is at least age 19 and under 24, and is a full-time student at an educational institution at least 5 months of the year. So, yes, there are some complications. So we want to try to keep the kids under age 18.
All right. As always, good insight. Thank you very much, Roger. Roger McEowen with the Washburn University School of Law joining us on the phone from Topeka this morning.